Hello everyone, my name is Melissa Locke and I'm Chair of the Finance Committee for World Physiotherapy. It gives me great pleasure to present this module on finance and reporting for the Leadership Academy. I hope you enjoy it. There are some key features of finance and reporting, and these include being able to identify risk, manage risk, control the risk, and the processes that help do all this. The second key feature of finance is budgeting. The third is reporting. And finally, and very importantly, is statutory obligations. As physiotherapists, we're not taught a great deal about finance in our undergraduate or postgraduate courses. Many of us learn these skills from owning a business, working in an institution or an academic institution where there is budgeting or grant applications. But many of us volunteer for a member organisation, a committee or subgroup and have very limited experience. I'm hoping that this information today will help you understand the basic principles of looking after finance. What are the key functions of a finance team? A finance team has a number of functions which may include managing receipts and payments, keeping accurate records of those receipts and payments, as well as deposits, managing the financial risks associated with the committee, subgroup, or organisation, providing helpful information, and completing all statutory requirements. Financial risk is one of the most important things for us to consider, and it can impact on an individual and also organisations. It can impact on an individual in that you may become accountable if you haven't analysed, evaluated, or managed the risk. And of course, it can impact on the organisation from a financial, a reputation perspective, to just name two. Risks in finance may include errors in paying bills or inputting data, theft by a committee member, or if you have staff, a staff member, fraud from the same people or by the same people, policy non-compliance, which makes it important that you have policies to follow so that everyone knows what's going on, and finally, inaccurate reporting. That means it's really important for us to have financial controls, and that's how we manage risk. These controls include policies and processes to manage how we deal with cash, how we procure services or items. That means purchasing things or services, how we allocate money for expenditure or gifts, how we pay a contractor or a staff member or a committee member or working party member, how we may travel and use our money to travel, and of course, human resources. And this includes things such as policies and processes on leave, be it holiday leave or sick or compassionate or personal leave, policies on staff absence, and policies on funding for training. Financial controls reduce the risk to individuals and organisations because they can make sure data is recorded and accurate, detect and prevent errors from occurring, or when those errors may occur, work out why they occurred, prevent and detect fraud or fraudulent behaviour, safeguard your assets, and help ensure an organisation is managed effectively. Tools to manage financial risk may include procedures, written procedures to manage cash and to make sure payments are authorised by the correct people. clear areas of responsibility and duties for people in an organisation, regular review of a delegated view, and reconciliation of expenditure, use of budgets and forecasts to identify any changes in income or expenditure, and regular review of who the organisation owes money to and who owes the organisation money. At this point in time, things sound pretty serious and scary, but rest assured that it isn't too scary. And once these principles are in place, it makes it quite easy to be a member of the team, the working party, subgroup, committee or organisation, or something as big as World Physiotherapy, without, a degree in accounting. So what we're going to do is we're going to look at financial statements. What is a financial statement? There are two most important financial statements: an income and expenditure or profit and loss statement and a balance sheet. And the components of a profit and loss statement are pretty simple. They involve revenue or income, expenses, and whatever's left is the profit of the organisation. If you look at this very simple income and expenditure statement or profit and loss statement on this slide, it shows that there's been membership contributions of $15,000, membership dues of perhaps $8,000, program fees for perhaps an educational program offered of $5,000, a grant of $7,000, and an investment income of $3,000, making a total income of $38,000. In this simple income and expenditure statement, we see that expenses for fundraising cost $5,000, general management and expenses were $7,000, and perhaps delivering a program or a professional development activity had the expenses of $6,500, meaning that the expenses were $18,500, but the change in net assets, our profit, is $19,500. This is as simple as a profit and loss statement looks like. This shows an organisation's expenses deducted from its income to give any profit. It covers a defined period. For example, January to June as a half year or a whole year, or it may be month by month that you review this statement, or quarterly. It resets to zero for each new financial or calendar year. Some parts of the world and some organisations work on a January to December financial year. Others will work on a 1st of July to the 30th of June of the following year, financial year. That is very dependent on the statutory requirements in the area where you operate. What's important to look for in an organisation's income statement? When comparing from one period to the next, be it monthly or quarterly, you want to ask, has your income increased or decreased from that previous year or period? And you want to know why. You want to compare changes or movements with your designated budget, which we'll discuss shortly, the previous year or period, or the inflation rate for the area where you're operating. When looking at expenses, you want to see if expenses have increased or decreased. You want to know why they have done that. You want to check for large changes or movement in these and look for trends. And compare, as for income, changes or movements with the budget, with the previous year or period, or the inflation rate for the area where you're operating. So let's look at this balance sheet. A balance sheet shows the organisation's financial position at a particular point in time. This could be the end of a month or a year, and it balances what an organisation owns with what it owes. It shows cash balances, how much an organisation's customers owe, how much an organisation owes to its suppliers, and what profits an organisation holds from previous years. When you look at this example on the right, you can see that our cash balance is $100,000, that customers owe us $20,000, that we have prepaid expenses of $5,000, and that we owe $125,000 in our liabilities and net assets. What are the things to look for in a balance sheet? You look at what the organisation assets are. In this instance or example, you can see our assets are cash and cash equivalents, short-term investments, and property and equipment. Have the assets increased over the previous year? In which area of the business and why? Or have they reduced? What has happened to the organisation's cash and cash equivalents? Is it the same? Has it increased or reduced? What are our liabilities? What is it that the organisation owes? And does the organisation owe more money than the previous year? If so, is that in what area of the business do we owe more and why? Let's now talk about cash management. The take-home rule is always ensure you have enough cash to pay your bills. It's a bit like your day-to-day living and your personal living. You don't spend more than you have in the bank or in your purse or wallet. So simply, income fills the tank and expenses drain the tank. If you don't spend as much as you earn, then your cash in hand increases. If you spend more than you're earning, you have a drain or a cash outflow. In cash management, when you're working on a committee or when you're working with a working party or an organisation, the question you need to ask when you're managing finances is, will the organisation have enough cash for next month? So what did you have at the start of the month? Add in the receipts, what you received, whether it was from professional development activities or advertising or member dues or subscriptions, deduct the expenses, and what is the cash at the end of the current month? Estimate and add in next month's receipts, next month's bills, and see if there is any cash left. When we're looking at how long you need to consider this for, the question we normally ask is, will the organisation have enough cash in 12 months to continue operating? This is the concept of going concern. Can you pay your bills for 12 months whilst you continue to go on with your activity of the organisation? To do all this, you need a budget. Budgeting and planning is key, and a budget, simply put, is a financial plan. It should link to the organisation's operational plan, which links to the goals of the organisation, what the organisation wants to achieve. Then you decide the activities to achieve those goals. Then you budget how much will those activities cost, how much will they bring in income, and then you decide if you can undertake those activities. A budget not only is a financial plan, it's used to monitor performance. When there are variances to the budget, it's important to understand the reasons and act upon them. Sometimes you need to vary your budget because there have been unintended consequences, such as COVID-19 not allowing you to undertake an activity that would have derived income, and therefore you have to adjust your budget and reduce your expenses to continue to be able to operate as an organisation. So the budget cycle involves preparing the budget, agreeing on it. Is this budget going to allow us to do the things we want to do? Implementing the budget, then comparing and feeding back and seeing, well, that activity worked and brought us income, that activity cost too much money, and therefore we have to change what we plan for our next activity. The cycle is ongoing throughout the year and requires reforecasting when things don't go as you initially planned in your initial step of budget preparation. Here's an example of a budget. So with the budget, you're thinking that you're going to receive some fees or subscriptions of $20,000. You may be getting income from an activity, a professional development course of $22,000. So you anticipate that for this year, you'll earn $42,000. But there is rent on the space you occupy, perhaps an office in a member organisation. There's staff costs, perhaps. There's light and heating, if according to where you live. There's insurance for activities undertaken, or perhaps the building or equipment. You may have staff, or you may have contractors that have administrative costs. And it ends up that your total expenses for the year are $38,000, but you feel comfortable with your budget that you're going to still have a little bit of profit or surplus. When you're looking at a budget, you then have to see as you go along, whether you review it monthly or quarterly or 6 monthly, what's varied. You analyse the variance and you take action. Let's look at this next slide. So in this instance, we see that perhaps the fees were reduced by $2,000. There were fewer customers or fewer people wanted to become members of our organisation. Our income from our professional development activity didn't change, but there is a variance of our total income for this period of $2,000. We should be okay because we know that we had a $4,000 surplus. However, what we find that our lighting and heating bills increased because it was a colder winter, and that our admin costs were increased by $1,000 because our project ran for a longer period of time. In this instance, our variance was actually $3,300 in negative, and so we only have a surplus of $700. But we're lucky that it's a surplus and that we haven't made a loss. This is why it's so important to do this, to review your budget on a regular basis. One of the other things that are so important to consider are the statutory obligations that underpin the running of your organisation. This relies on external reporting. For World Physiotherapy, we must report, as we're based in the UK, to the Charity Commission for England and Wales. And we submit annual reports to the UK Charity Commission and need to ensure that we are performing and behaving under their guidelines because we are a charity within the UK. Depending where your organisation is set up, you have statutory reporting requirements, which may also be to government offices, taxation departments. Taxation, for most countries or territories, there are two main types of taxation. There is direct tax, which is on the profits of an organisation, such as corporation tax in the United Kingdom, or there is indirect tax. This is tax on goods sold and services, and these can include things such as the value-added tax or goods and services tax. Indirect tax is on products and services used, not on individuals or organisations. Taxation requirements will differ according to how your organisation is set up. Is it a charity? Is it a company limited by guarantee? Is it a sole trading? Is it a proprietary limited? So I hope you've enjoyed this brief introduction to finance. And I hope it hasn't scared you too much at all, and has in fact encouraged you to go and learn a little more. It has covered the main important issues of understanding a profit and loss or income and expense statement, a balance sheet, the importance of budgets and reviewing budgets, the importance of what are the statutory requirements for your organisation within the location where it is based, and the need for reporting. But most importantly, the requirement to evaluate, manage, and report on risk. We are more than happy at World Physiotherapy to provide extra input and advice on where to head for more information. And we look forward to chatting with you at your face-to-face component of this module. Bye for now.